Hey everyone. Verizon has been a favorite for passive income investors all year long, but the stock has performed relatively modestly, down 5.5% for the year. But is Verizon stock a buy for 2024? Well, that's the question I'm going to answer in this video, looking at the company's prospects for 2024, its balance sheet position, its valuation, and the profitability of the business longer term. According to those metrics, I'll come up with an answer of whether or not I think Verizon is an excellent stock to buy for passive income investors looking to generate a solid dividend income and dividend yield. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. I mentioned already that Verizon stock has had a modest year, falling to begin all the way through October, and it was down as much as 20-something% on the year before bouncing back in recent months, being down just 5.5%. Verizon stock price is down despite a relatively solid performance in 2023 in terms of business performance, fundamental performance, adding customers, and so on. So it was a bit surprising to see the stock price fall as much as it did for the first 9 months of the year. You'll notice here the trailing 12-month revenue for Verizon has been fluctuating for the better part of the last decade, and these fluctuations are uncharacteristic of the company's foundational prospects. Verizon's business is extremely sticky. More than 99% of its customers renew their subscriptions with Verizon. Rather, these ups and downs have to do with divestitures and acquisitions of the business, and so it makes its revenue and look more cyclical than the nature of the business overall. The big story in 2023 has been fewer upgrades for phones. The plans and the new phones, the iPhone and others, have not enticed consumers to upgrade their phones at the same rate that they did in 2022, right? And it could be also that so many people upgraded their phones in 2021 and in 2020 when they got those massive stimulus checks that they've held off on upgrading their phones for maybe a little while longer. But that's good news coming into 2024, because that means these phones are now getting old, right? You might be surprised to hear that a phone from 2020 or 2021 is getting old just 2 or 3 years after use. But that's typically the upgrade cycle for these smartphones. They get upgraded every 2 to 4 years on average, depending on the use case. And so that could be a bullish tailwind for Verizon in 2024. Also, there's risks of a recession or a slowing economy in 2024. Economic forecasters suggest a 1% GDP growth in 2024, which is slower than potential GDP, meaning that the economy is not going to be growing at potential. It's going to be slowing down. And in these types of scenarios, Verizon does relatively well because its business is sticky, like I mentioned earlier. If people lose their jobs, they're not likely to cancel their internet plan, their wireless plan, because that's an essential part of their life. But if people lose their jobs, they're probably not going to buy a car, right? So those are the things that get cut, things like travel and new car purchases. But things like your cell phone plan are the things that do not get cut. So that could be good news for Verizon. Overall, $134 billion in revenue. And organically speaking, the core business without acquisitions, investors can reasonably expect this business to be relatively flat or growing about 0 or between 0 and 4% per year, I would say. It's not going to be a fast growing business. It's a saturated market, and it can add incremental revenue, but it's not going to grow at a double-digit rate, right? So this is something that the passive income investors should understand about Verizon's business. I mentioned earlier that Verizon is a favorite for passive income investors, and it's because of this robust 7% dividend yield. That's one of the stronger dividend yields in the market from a company that's got solid balance sheet and solid cash flow prospects. Now, there are some stocks that are offering a higher dividend yield, but those stocks are in financial trouble and there is a dividend cut imminent, right? But that's not the case, I don't think, for Verizon. I don't think a dividend cut is in the works for Verizon. Its financial position is relatively strong, as I will show you in the next few slides. Starting with its profitability, its operating profit margin has consistently held above 20% since 2016, fluctuating between 25 and 20, but staying above 20 for the better part of the last decade at 22% in the most recent trailing 12 months. That's an excellent operating profit margin for a company the size of Verizon. The scale of this company is massive, and this operating profit margin is excellent, to be sure. Additionally, Verizon is a cash flow machine, generating $37.74 billion in cash flow from operations in the most recent trailing 12 months, and this figure has held above $30 billion since 2018 and fluctuated above $40 billion for a couple of moments here. So the company throws off strong cash flow from operations, and that's why I suggest that the dividend is not in danger of being paused or reduced, because the company is generating very strong cash flow from operations. That's enough to support the dividend and its absolutely massive debt load, which I'm going to talk about in the next slide. I mentioned Verizon's massive debt load, $147 billion in total long-term debt. That is one of the largest figures of long-term debt out of all of the companies that I follow. AT&T comes close, Ford comes close, but I think Verizon has the lead here in terms of total long-term debt of all of the companies that I follow. It's a massive debt load at $147 billion with only $4.2 billion in cash, right? So that difference is large. The good news for passive income investors is that Verizon generates over $30 billion in annual cash flow. So that's more than enough cash flow to pay its dividend and to help pay down the debt and leave off extra cash flow to reinvest in the company to maintain its networks and build up a base so that when the next technology comes in, right now they just finished investing in the 5G technology, or they're just about finished investing in the 5G technology. In a few years from now, they're going to need to invest in the next technology, right? And so they've got enough cash flow to support all of those things, to pay the dividend, to pay the debt, and to save up for investing in that next technology. That cash flow is strong. The business is lucrative and it's throwing off enough cash flow. Nevertheless, this is a risk. If there should be some disruption to Verizon's business, then this debt becomes a big risk, because if it's not generating the revenue, the cash flow to support this long-term debt, then the business would be really in big trouble, because it's got this $147 billion and it's going to be difficult to support this unless you're generating the level of cash flow that you're generating. And finally, I wanted to look at its valuation. Verizon is trading at a forward price to earnings of 8.066 to be precise. So the stock is not expensive. It's trading at about a price to earnings ratio of about half the average S&P 500 stock. And so it's not expensive. And that's understandable. There's a reason why it's not expensive, right? I mentioned you cannot expect this company to grow very fast. It's in a saturated market. It's got massive amount of long-term debt. And so the combination of those factors has Verizon stock selling at a relatively cheap valuation. That being said, though, if passive income investors are looking for a strong dividend yield, then Verizon stock is an excellent choice for them. It is, in my opinion, it is a buy for dividend stock investors. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.